Control W, and that makes it hide. If you don't click on it before you do that, though, it actually takes you out of the meeting. So I did that once. So yeah, just make sure your mouse is on the little drop down. So when Remit asked me, he's like, hey, what do you want to talk about? I immediately kind of thought about standard cost. And because there's a lot of companies that do standard cost, but I think there's a lot of maybe confusion or maybe just stuff that people may not know about standard cost inside of D365. And so that's why I wanted to talk about it. But as I was looking at the topic of standard cost, it's big, right? So you have standard cost that affects lots of different areas of the business. So in the hour, the next 45 minutes that we have together, I want to focus in on the purchasing side of standard cost. So when you think about standard cost, and I'll get into this in just a bit, but it covers inventory, sales orders, production orders, and purchasing. So we're going to talk about specifically around purchasing today, and then maybe in the future we'll do another session around the other pieces of it. So we want to first talk about what is standard cost, and then we want to talk about how does standard cost impact purchasing. So you can have a purchasing PPV or receipts, invoices, and then you can also burden your standard cost using the cost sheet. And then we're going to look at the standard cost transaction table that allows us to see more granularly where these different costs, standard cost variances are coming from. So the first thing I want to talk about is why would a company even do standard cost, right? So whenever you have LIFO, FIFO, weighted, and standard cost, those are the main different types of costing methods that you have. So the reason a company would do standard cost is so that they can have predetermined cost, so that they can say, hey, this is what I'm expecting the cost to be, but this is what the cost actually is. So now all of a sudden you can start seeing this variance. If you do LIFO or FIFO or weighted costing methods, you don't really know how much your cost is fluctuating. So from a finance perspective, that can be a little bit scary, frankly. But if you're in a commodity market, meaning you're in a market where the costs fluctuate a lot, standard cost just doesn't make sense because you're going to have so many variances all the time. So if you're in like gold, or you're doing wool, or you're doing oil, some of these other type of commodity markets where they go up and down a lot, I wouldn't recommend standard cost. It really just, it's too much because you end up with too many variances. So standard cost isn't for everyone. However, if you're in a pretty stable market, meaning your raw materials and your finished goods pretty much stay in the ballpark for six months to a year, then standard cost may be a good option for that. So again, it creates this predetermined cost for your materials and your labor. And then it gives you cost control so that you can measure those variances. And then you can do variance analysis. So as a finance person, we're all about trying to find out where the money's going. So if you have huge labor cost variances on the production side, or you have huge raw material cost inflations on the raw material side of things, you want to know that. And so standard cost is what enables you to see those variances. So like I mentioned before, standard cost in D365 touches production orders, which by the way is a whole big thing. And we could spend an hour talking about that. Maybe we will at some point. It affects your inventory value, which is pretty important because your inventory value is going to sit on your balance sheet. Some people actually borrow money against their inventory value so they can get loans from the banks. They also, it's an ongoing, it's an asset, but you have to keep track of maintaining all that inventory and all of that. So you want to make sure the inventory is valued accurately. Then you have standard cost, you have sales orders. So when you sell something, you sell inventory and you have cost of goods sold. Well, that cost of goods sold is based upon that standard cost. So, and then we have purchasing. So today we're going to talk about purchasing. And there's three different types of, well, not really. There's two different types of PPVs. So there's purchase price variance on the receipt. There's purchase price variance on the invoice. And then you can actually burden the inventory with some other overhead cost. Now, when I say the PPVs are different, the PPV on the receipt, the purchase price variance on the receipt and the invoice go to the same GL account. They don't go to two different GL accounts, but the system will calculate them at those two different points. All right. So what I want to do now is I want to go into the system and I'm going to show you a purchase order for just a normal kind of PPV. Okay. But before we get started, we're going to actually start out with released products. So I'm in the released products, and we're going to be looking at this glass cover to start with. Under the general tab, you'll notice there's something called item model group. The item model group is what tells the system what your method of costing is. So your inventory model is going to, in this case, be standard cost. So it's very important. If you get this wrong and you start transacting, you really can't fix it. You have to pretty much set up a new item and move everything. It's not very forgiving. So make sure that you do have this set up correctly. But the costing method lives on the item model group. Then if we keep on going down here, we're going to get into this purchasing section here in just a little while. But to actually put a cost, a standard cost on this item, we go up to manage cost in the ribbon and click on item price. Now, one thing to know about costing is by site. So you see site here. Costing is by site. And this is really, really important because some people will come up and say, hey, if my inventory is in this warehouse, I want it to have a value. But once it gets put into this other warehouse, I want it to have no cost. Okay, sometimes people will do that for seconds and like refurbished products or things they've already fully depreciated. Well, really what they're saying in D365 language is you need a different site. So costing is by site. So here you can see if this item is sitting at site 1, it's $32.35, but if it's in site 2, it's $75. So again, costing is by site. To put in a cost, you just click on pending prices and you click new. Then you're going to give it a costing version. And at some point, again, we ought to have to do a whole session around the configuration and setup of standard cost because you do have versions. You have the cost sheet, which we're going to get into today. There's calculation groups and some things. So for now, I'm just going to tell you to pick a version. And then you're going to pick the site that you want. And then pick the site. And then you put in the price. And then you save it. And then you activate it. So I've already got one activated. Another thing to know about your cost is with standard cost, your inventory value is valued all the same all the time. So if I were to actually go change the standard cost from $32.35 for site 1 to $35, all of my inventory value is now going to get revalued at $35. So know that that's the case. So standard cost, all inventory has the same value for that particular item and site all the time. So that's the case there. All right, so now we're going to go over here and look at a purchase order. And on this particular purchase order, let's see what tab I have it on. No, actually, let me open up my spreadsheet too. All right. So we are going to be looking at this 3375. So just to kind of take you back a little bit. So here we have a purchase order. Okay, so this is the display dial. So again, if we look at display dial for site 2. Right, so we click on item price. For site 2, we can see the price is $50. So that means the standard cost for this particular item is $50, okay? If we look at our purchase order, we have a purchase price of $55. So what's going to happen when I post that receipt, I'm going to get a PPV or purchase price variance of $5. And the reason for that is because my standard cost is $50. I paid $55. So the difference between those is $5. So when I look at these postings, I can see I have a purchase price variance for $5. So that happens there. Then if we come up and say, you know what, we're going to invoice this. And let's say we invoice this at $57, right? So now it was $50 for standard. We have $55. Now it's $57. What you're going to see is the system's going to calculate that $2 purchase price variance here. So I'm going to show you the vouchers. So if you were to dump those vouchers into a spreadsheet, what you're going to see is you're going to have AP for $57. You're going to have your accrued purchases not invoiced, which is 0, which is right. And then you're going to have a total PPV of $7. And then you're going to have an inventory value of $50. Okay. So just know that the system is always comparing your purchase price and your invoice price to that standard cost. And then that delta or the difference between those is posted to PPV. All right. So I think that's pretty basic. Probably you guys are all probably pretty familiar with that. Your postings, the GL accounts come from your posting profile. So just know that all your standard cost GL accounts comes from under inventory and then posting and posting. Then you have standard cost variances. So these are all your different standard cost variances, and this is where the system knows where to actually post those things to. So their PPV went to this account here because of this. Okay, it kind of makes sense. Hopefully you follow tracking with me here. All right, so that's the basic piece of it. Now we're going to hop back over here to our PowerPoint. And I want to ask you a question. So how many projects have you worked on where the customer said, I may buy this for, let's say, $30, but I have freight costs, I have handling costs, I have overhead costs. So if I just put my purchase price as my inventory value, I'm actually understating my inventory, right? Because standard cost does not equal purchase price all the time. And so one of the things that you can do inside of D365 is you can actually burden that standard cost with costs other than just the purchase price. So that's what I want to show you today. So why would you do this? One, again, like I said before, you're going to have other costs. So just because I bought this phone, right, for $1,000, that doesn't mean it cost Apple $1,000 or me $1,000, because there was freight involved, there was handling costs involved, and different things like that. So really what I want to do is I want to put this in inventory maybe at $1,100, right? So that way my inventory actually gets valued properly. So that's why, so you can get a true cost or representation. The other reason you may want to do this is so you can do a better profitability analysis, because when you include your overhead, now you can make more informed decisions. You may be like, okay, great, I can buy that for, $1,000 over here, but I've got to bring it in from somewhere overseas, and it's going to add $300 to it, right? Or it could come up and say, but if I buy this in another place, I may pay $1,000, only have to pay $100 to get it here. So if you don't know that full holistic cost of something, you're really not you can't really evaluate what the cost of something is. So it really helps make sure that you have inventory accounting compliances, because again, if your cost of goods sold, if your inventory value is wrong, then guess what? Cost of goods sold is wrong when you sell it. If cost of goods sold is wrong, that means your profit margins are wrong, right? Now all of a sudden your profit margins aren't accurate. So it's really important that you do have the accurate cost in inventory of what that value is. All right. The other thing that happens is in some of the businesses that you work in and some of the businesses I work in is they are like, should I buy it or should I make it? So somebody, a costing engineer, is sitting down and they're going through this analysis and they're trying to figure out, okay, well, if I make it, I've got labor, I've got all the, my equipment, I have all this stuff that is going to take me from a cost perspective on making this product. And now they're like, oh, well, I can buy it. Well, guess what? If your standard cost just is your purchase price and not fully burdened, it may actually look like it's cheaper to buy the thing than it is to make it. But real life, that may not be true. So it really gives you a lot of good information to be able to make good business decisions about whether you make a product or you actually buy it. So I want to show you what this looks like. So we're going to go back into D365. And we're going to take a look at our cost sheet. And the cost sheet, let me go ahead and put these up. Okay, here we go. So the cost sheet has two nodes in it. So when you're in a cost sheet, let me just roll these up here. You either have a cost of purchase node, right? Cost of purchase, or you have a cost of goods manufactured node. So the cost sheet in its basic definition is nothing more than a calculator that you're going in there and you're saying, when I'm creating my standard cost for my purchasing, or I'm creating my standard cost for my production stuff, what do I grab? Like what cost groups do I use, or what overhead percents do I have, and all of that. So in today's session, we're going to be focusing on this cost of purchase. And again, this is things that I'm buying. So I have a note in here for material, and then you'll notice that I have all these different cost groups. So I have a cost group for M1, M2, M3, and M4. There's nothing magical about that, okay? And you'll notice that the cost type is direct materials. Nothing magical about that at all. Someone had already set up part of this cost sheet for a sales demo, and I didn't want to mess it up, so I just left it in there. But you can have as many cost groups or as few cost groups as you want. The reason you may want to have multiple cost groups or different things is if you want to discriminate or have different calculations based upon the cost groups. Because if I had one type of item, I may want to say like, hey, it may have a handling cost, but it doesn't have an admin cost, for example. So in that case, I would create multiple material nodes in here. So when I get down here to the purchasing piece, I can actually discriminate on these different nodes to do that. And also, like in this example, you can see I have M1, 2, 3, and 4. So if I were to have an item that didn't have a cost group of M1, M2, M3, and 4, then the calculator is not going to pick it up at all. So that's just a way of discriminating or choosing which kind of items are actually included when I run the calculation. Okay. So I'm actually going to hop over here to release products because I do want you to see that. So you can see here's M1. So I have an item over here that has a cost group of M1. So when I actually run this calculation, the system is going to go, oh, wait a minute, you have a cost group of M1. Is M1 on your cost sheet? Oh, yes, it is. Let me pick it up. But if I were to run the calculation for this item, it doesn't have a cost group. So when the calculation runs, it's going to go, oh, I don't touch you. There's not a match. So that's how that piece of it works. So there's that part. Now we're getting into the fun piece. So this is the overhead. Now, these are the things that I want to add an additional cost to my standard cost. Okay, so I have an item for $30, right? So if I go over here and look, I have, I buy this thing for $30, so that's that piece. But then I want to add some additional cost to it. So in this example, I set this up as a surcharge. A surcharge is a percentage. If you look at this one, it's a unit base. That is a flat rate. So here what I'm saying, hey, whatever the value happens to be in this node called COP material, whatever that value has to be, I want you to add, see this per item here? It's going to say, I want you to add, for site 1, I want you to add 2%. So whatever that value happens to be, I want you to add 2% to it per item, okay? If it's for site 3, it's going to be 2%, but site 5 is 3%. Now, when you do these, you can do this by costing version and by site, but you can also do it for a specific item or item group, because you may say, hey, I want everything that's in this group to get 2%. But in another group, it may be something else. So here I could pick group, and then my relationship here is going to be my item group, and then I could put my percent. Or if I want, I could discriminate actually down to the item level and actually point to a specific item and say that specific item has a certain percentage. So there's a lot of flexibility around that. All right, now what's going to happen? You're down here in the ledger postings. For all my finance people in the room, we'll nerd out here for a second. You have what we call physical and we have financial. So what that means is that whenever I actually post my receipt, so I have this item, I've done the item calculation, then whenever I actually buy this thing and I receive it, then I'm going to have 2% go to this account. And this account right here is going to be the accrued freight absorption account. So when you're looking at your trial balance, it's going to be in your P&L, and it's going to be your accrued freight absorption account. Again, it's an estimated amount because this is not actual costing. So just know that piece. And then whenever I actually post the invoice is the financial. So anytime in the system you see physical, you'll see financial. Physical On purchasing is the receiving, financial is the invoicing. If you're doing production orders, the physical would be like posting the pick list and posting the route, and then the financial would be the end function. So say for sales orders, anytime you see physical, that's posting the packing slip, posting the invoices, the financial. So whenever we post the receipt, we're going to be posting the 2% to this accrued freight absorption. When we post the invoice, it's going to clear out this absorption account and it's going to put it in this accrued freight account. Okay, so that's what that does. If you do want to associate financial dimensions with these postings, you can. I didn't do that, but you certainly can if you choose to do so. Okay, so let's move down here just a little bit more, just so you can see a little bit of a different scenario. So again, surcharge percent, unit-based is a flat amount. So here we're saying for the quantity, so we're saying per quantity, per item, in this case, we're going to have a rate for site one of $1. So we're saying every time, if I were to order, for example, if I ordered 100 on my purchase order, then this would be $100 because it's going to take 100 times 1, which is the amount. And that would give me actually a storage unit cost of $100. And down here again, same kind of thing. We're going to have our accrued handling absorption account. And then we're going to have our accrued handling account whenever we actually invoice it. And then this is just another example for administrative cost. And it's doing the same thing. Unit-based quantity per item for 75 cents. Okay. All right. So this is your cost sheet. By the way, if you can copy and paste, so I worked on a project one time and they had a gazillion things like in this rate section or the surcharge section. I don't remember which one it was, but same thing. You can literally copy and paste these from Excel into here. So what I usually do is say export all rows, get the format, and then populate it in Excel. And you can literally copy from Excel and paste in here. And then also, I don't know if you've done this before, but it looks like you have to activate each one of these individually. You don't. There's actually a process that you can run, and I blogged about it, where you can actually activate all of the different surcharges and rates at one time. So don't feel like you have to click there and say activate, click and activate. One time I did that and I went crazy. And I'm like, there's got to be a better way. And there is. There's a process you can run that'll do them all for you at one time. Okay, so again, cost sheet, cost of purchase, we have our cost group, and then we have our overhead. Now, how does the system know what the purchase price is? So this is the first part. So we're going to hop back over here to our release product. My session keeps timing out. I need to go change my setting. Okay. So we're going to go into our plastic cover. And the system knows in this purchasing section, so again, release products and the purchase fast tab, we have our purchase price. So when I actually run the item calculation function to get the standard cost, it's going to use this price. Okay. Now, if you have this last purchase price field here set to yes, then that means every time you invoice this item, this price is going to change. So if you were to then run your item calculation again, it would pick up this, whatever's here basically is what it's going to use when you run the calculation process. Some people don't want the last price to update every time they invoice, and some people do. It's this flag, totally up to you. Just know that if you do set this flag, this right here is going to float. And every time you run item calculations, it's going to pick up whatever's there. All right. The other thing to pay attention to is this price quantity. So right now I'm saying it's $30 per one. But if you got into a situation where you wanted the cost to go out more than 2 places past the decimal, you may want to put in a purchase price quantity per dozen or per 100 or per something like that. That way the system will then take this price divided by this quantity, and then it'll use that as the purchase price when it's doing the calculation. Because again, you can't change the number of decimals. And so that's how you kind of, I don't want to say manipulate, but that's how Microsoft expects you to manage decimal locations, is by changing this price quantity. All right, so there's that piece. So this is really important. So this is where it's going to get the $30 from. whenever it's doing the purchase, getting the standard cost piece for that. And if we go down here to manage costs, we can see have our cost groups. Our cost group again is M1. And again, price quantity, I have it set to 1 as well, but if you do want to manipulate that, you could say it's per dozen, per 100, and so on. All right, but this is, all right, so let's do this. Under manage costs, when I go to item price, I'm going to go to pending prices, and I'm going to say calculate item cost. And again, you don't have to do this one by one. There's a place on the costing version where you can do them all together. So I'm just doing a one-off just for proof of concept so you can see how it works and we don't have a bunch of data to look at. All right, by the way, when you're doing this item procured using section, if this is not defaulting correctly, like this goes to production or something like that, that's coming from your default order settings. So if this is not default properly, it's you have a setup issue on your default order settings. Okay. And then we're going to click OK. And now's when the magic happens. So we went out and we have, why didn't I pick it up? Oh, I did for site 2. I should have done it for site 1. Well, here, we'll look at this. We'll look at what I did already. Okay. So we go to our cost rollup group. My only one item. There we go. It's this one. I had it on the wrong thing. I should have done it for site 1. That's why I didn't calculate. All right, so here we go. So we can see we have our purchase price is $32.35. Okay. Our item is $30. But we also have 2 cents for freight. We have $1 for handling, and we have 75 cents for administrative cost. All right. So everybody see that? So our total inventory cost per unit is going to be $32.35, but the system knows that $30 is for the purchasing price, 2 cents is for the freight, $1 for the handling, and then we have 75 cents for our administrative cost. All right. So that's what our inventory value is going to be for site 1. On these other ones, I plugged the value because I did another test, and I'll show you that here in just a bit. Okay. So now if we go over here and look, let me pull up my spreadsheet again. We'll look at this one. So we're going to look at PO 3326. So purchase orders. All right. So we're going to look at this guy. So you can see that we bought it for $30, and I just did a quantity of 1 just to keep the math simple. So we bought it for $30. When we look at our product receipt, I've got the vouchers here. Probably easier to see it here. You can see that we have accrued purchases for $30. We have inventory, and I'm looking at this column here. So we have accrued purchases for $30. We have our inventory. Again, inventory value is fully burdened at $32.35. Now here there are overheads, right? So we have our freight for 60 cents. We have our handling absorption for $1. We have our accrued for 75 cents. All right. So that's what our receipt looks like. And you'll notice we don't have any PPV, right? And that's on purpose. And I'm going to show you an example here in a second. That's for the other site 2, where I actually burdened just the standard cost so you can see what that would look like. So again, our inventory got fully burdened, but we have it all broken out into these absorption accounts. So from an accounting perspective, this makes us very happy. Okay. Then we're going to actually go through and invoice it. So here, these are all the invoice journals. So starting on line 7, going down. So here we can see that our inventory value is still $32.35, right? And then we have accrued purchases not received or not invoiced. These actually get zeroed out like I've done here. So this is what you end up with. So you end up with, this is the invoice and the receipt combined. So you have a credit to AP. You have a credit to accrued freight, because again, it took it out of the accrued absorption account and moved it into the accrued freight account when I invoiced it. So that's what that's for. Now we have our accrued handling for $1, accrued admin for $75 or 75 cents rather, and then we have our total inventory value for $32.35. Okay, tracking with me? So that makes sense. So if you do the cost sheet, then if I look at on-hand inventory, we're going to see that the value of that inventory is actually fully burdened at $32.35. So that's what you want. So now whenever I actually am looking at my on-hand inventory, it's $32.35. When I actually sell this piece of inventory, it's going to be cost of goods sold is going to be $32.35. So now I've got this fully burdened item that is being costed accurately. So now I have accurate profit margins. Now, somebody may say, okay, well, fine, I don't do that. I just want to be able to say my standard cost is $32.35, period. You know, like, well, what's the harm in that? If I just do it in a spreadsheet over here on the side, I calculate all this and I say, yep, it's $32.35. I'm just going to make my standard cost $32.35. If I could see you all and had a show of hands, if I had to guess, half of the group is going to have people that do that. The downside to that, and again, I'm going to show you one here. If I had actually done the exact same scenario and not burdened it, if I had just gone into, let me go back to my item. I think I just, so this is PO 330. What's this little guy? See, in here, I did this one for site 1. So it's $30. And then, but what would happen is it's going to go through and input it all into PPV. So if I did the receipt, so here you can see I did the same thing. So the purchase price was $30. So I now have a PPV of $2.35. But now I don't know why I have a PPV of $2.35. Was the vendor generous and actually just sold me the product less expensive? Why? What's this variance doing? Like, I don't have any idea. But if we break it up using the cost sheet, now I know the why. Now I know that it's from freight overhead and admin. And if we look at the inventory or the receipt and the invoice together, we go over here and look. Again, we still end up with the same accounts payable amount. But now we have this PPV and we end up with the same inventory value. So let me show you my PowerPoint again. I'll show you this. So this is what it looks like. You can see that AP is the same. Okay, that's nice. You can see that inventory is the same. Okay, that's nice. But now this accrued freight, handling, and admin is making up this $2.35. If I don't use the cost sheet, I have no visibility to that. So as a finance person, if I'm the controller, I'm sitting there again going like, okay, guys, why do we have this variance? The other reason too, when you actually get your real freight bill, you really want to offset this or at least do some kind of analysis to say, hey, I estimated that my freight was going to be 60 cents. What was my actual freight? Because it could be that, you know, the freight value has gone up or down, but in a material way. If it's gone up a penny, okay, fine, you know, expect some fluctuation, that kind of thing. But if it's like big swings, you may want to start looking into that. But if you don't have this broken out this way, you have nothing to compare your budgets to your estimates, which are here, to your actuals. So this gives you that visibility into being able to do that. The other thing I wanted to show you is there's actually a standard cost transaction table. So all the things that we just did are actually in a table all by themselves. And I want to show you the InventTrans table too, the inventory transaction table. But before I get there, we can get there from here actually. So there's a table or a screen called Standard Cost Transactions. And so here you can see our display dial. You can see that here's our purchase order, our 3375. We had a quantity of 1. The cost contribution was 50, and then our variance was $5. And again, when you go through here, you have a type and you have a state, and then you have a number. So this is very similar to your inventory transaction table, if you're familiar with that. A type receipt just means it came in, and issue means it went out. It really has nothing to do with purchase orders, sales orders, or any of that. That just means inventory went up or inventory went down. That's all that means. State is either physical or financial. Physical, again, is the posting of the receipt, posting of the packing slip, the posting of the pick list, those kinds of things. Financial would be posting the invoice on the purchase order, posting the invoice on the sales order, ending the production order. That's going to be your physical. And when you're here, you go down to the bottom, you can actually see, okay, so this is what the cost group was, the cost and the variance. You can see the ledger accounts that it hit. If you go up here to voucher, you can see what vouchers or what GL accounts got posted to. So it gives you a lot of flexibility as far as like navigating and backing into the why. So as a finance person, if I was sitting there and I started seeing some big variances in here, I'm going to be going, okay, like here, for example, that's a pretty big variance. Why? You know, and then you may want to say, well, let's look at the transactions. So then you can back into the transaction and I can say, okay, so this is my item number. It was for site one. I can see the purchase order. I can see the quantity. I can see I have a physical cost, but I do not have a financial cost yet. So immediately I know it hasn't been invoiced. And then if I want, I can click on this number. It's going to take me to the purchase order. And now I can start doing some analysis on it. Start saying like, gee whiz, why did this happen? So from a finance perspective, this is really helpful because again, your standard cost variances are hitting your trial balance. But whenever you look at that trial balance, it's a number. And then you're thinking, okay, well, what does that number mean and why? Like most accountants or most controllers have a really good idea of what their variances are acceptable, like what's in range. But if they start seeing stuff like, hey, this looks suspicious, then going into this transaction table, super, super helpful. And going into there, I want to take a look at this one. I think this was the one I wanted to show you. Yeah, I think this was the one. Okay, good. This is good. So this one is the display dial that we did for this purchase order that we looked at a second ago, 3375. You can see as a quantity of one, you can see our physical cost was $50. You can see our financial cost was $57, and we have an adjustment of $7. The reason for that is because we had, this is the first example that we did here, where we actually had we said that our cost was $50 and our purchase order was for $55. So we ended up with a $5 PPV on the receipt. And then we said we invoiced it for $57. So the difference between 50 and 57 is at $7. And as a result, when you look at your inventory transaction, you have an adjustment of negative $7. So there's a lot to be said in this transaction table. I hope you know where I'm at on the screen here. So there's a couple ways you can get to this transaction table. One is from the standard cost transaction. Another one is from the actual item. When I'm doing any kind of analysis, I dig through this inventory transaction table a lot. So we go under manage inventory, and then here it's transactions. It takes you to the same place. So again, you'll see our $7 here, or you can get to it from inventory and inquiries and reports, and then transactions there too. So, but then you have your physical date, which is your receipt date, your financial date, which is your invoice date. And you can see that it's a purchase and so on. So it allows you to tell a story. Now, I hope you're kind of seeing how all this stuff can fit together. But one of the things I wanted to really call out or kind of talk about was this cost sheet, because I think a lot of people don't realize they can do that. And it's just a really cool way of burdening your inventory without it being too heavy of a lift. One of the questions I get asked whenever I bring this up is they're like, well, why aren't you doing landed cost? Right? I don't know if any of you that crossed your mind when I was doing this. You're like, gee, this looks a lot like landed cost. Well, inside of D365, there is a landed cost module, and it's great to use. I don't know if I necessarily use it with standard cost because it gets kind of a heavy lift from a maintenance perspective. If you're going to use landed cost, I would probably look into a different costing method other than standard, just because of how you have to update the standards and stuff like that around landed cost. But landed cost allows you to deal with voyages, and it also allows you to do estimates to actuals. Now here you notice we were able to do estimates, but we weren't able to do actuals. So when that freight bill comes in, I'm not saying, hey, this purchase order that was on this voyage had this freight across these 50 POs. Because lots of times when you are doing true landed cost, you may have 50 POs in a particular container or a voyage. So when you actually get the freight costs and the duties and all that kind of stuff in, It's for a group of purchase orders, not a purchase order. So if you're really wanting to get into like high complex landed cost, highly recommend looking at the landed cost module. If you are doing kind of basic landed cost, or even if it's just landed cost or cost within your own country, where you're maybe having to move products from different geographical locations within your own country, this could be a really good option. Before Microsoft put landed cost in D365, this is what we did. This is how we kind of managed that to make sure that we were burdening our item with the landed cost value, at least it's some with an estimate. So I hope you learned something through this. And if you haven't checked out the cost sheet using the cost of purchase, I hope you will check it out, and hopefully you've learned something today, or at least spark some curiosity. So Ramit, I'll hand it back over to you and see if we have any questions. Let me get back to my teams. I'm going to stop sharing my screen because as soon as I pull up my teams, you're all going to see yourselves. So, all right, very good. Let me take a look at the chat. Do we have any questions here? Okay, so you're asking, how do you set up location-wise standard costs in the cost sheet? So the location is the site. So whenever you're actually on the cost sheet, and I can share my screen again, when you're on the cost sheet, you'll notice that the costing is by site. So if I go down to the surcharge section, just as an example, there's the site. So if I had, let's say I had a warehouse in China, and I had a warehouse in India, and I had a warehouse in the UK, just as an example, the cost for that could be significantly different depending on where it's being transported to and from and stuff like that. So you may actually want to have a different overhead cost by site. And then when you're actually on your released product, you go to manage cost and item price. When you actually run your calculation, then you're going to pick that site. So if like one was India and one was China and one was UK, you pick those. And then whenever you buy something for that site, the system knows what cost to pull in. Did that answer your question? Do we have any other questions? Has anyone used this before? I'm a little curious. Has anyone used the cost sheet to burden their item cost? Maybe, maybe not. Okay, cool. But there are a lot of things around the inventory, that inventory transaction screen. As you start digging into your standard cost, you want to look at the standard cost transaction screen, and you want to look at your inventory transactions. Because as you're going through stuff, you're going to start seeing variances, and you're going to start seeing stuff, and it can be difficult to kind of understand what it is until you understand those two particular screens. But the beautiful thing about standard cost is once you get it set up, it just works. And updating standard cost, I almost feel like we should do a whole nother session on how to update standard cost, because there's a lot of little tips and tricks that you can do to update standard cost where it's not that big of a, not so difficult. If you don't really know how to do some of the tips and tricks, it can feel like a real burden, no pun intended, on updating the cost. But if you do know how to do it with some little tips and tricks, it's not a heavy lift. So good. Anybody else have any more questions?
Sorry. Have we taken all the questions from the chat, or I can read it? Like first question Vaibhav has asked.
It looks like we have one more question here. What is the difference between planned cost and standard cost in the item price calculation? When do we use planned cost versus standard cost? Good question. Threw me off for a long time. So planned costs are costs that you cannot actually activate. However, this is what threw me off for a long time, and it still kind of throws me off. I feel like I need to test this some more. A planned cost goes in and saying, this is what I think I want my cost to be. So that way you can kind of go in and do some analysis. It's based on your costing version. When you set up your costing version, you tell it if it's a planned cost or if you blocked activation, which means you can't activate it. However, planned cost is used, like if you're doing, I'm fairly certain, I need to go back and test this, but if you're doing a production order and you have a planned cost, it'll use that cost. That really threw me off one day because I was doing something, all of a sudden I started getting my planned cost. But if there is rule of thumb, though, the plan cost is a way for you to go in and actually say, hey, this is what I want to kind of tinker with stuff. I don't want to make sure it doesn't get activated. I just want to say, hey, I'm looking at my cost for 2026. What is it going to look like? What if I put in this value? And then you just put that in as a planned cost. So that way you can start doing that analysis on there. So that's what I personally have used it for. But I do think it does do something with production orders, though, because I ran into it one day. The standard cost transaction form and what is a transaction type towards the cost scenario for 32. Oh yeah, perfect. All right, so let me share my screen again. And we're going to go back. Oops, let me do Control W, find my little drop down. And I don't remember what tab I had that on, but it's fine. I'll split it up. We go back here and we go to standard cost transactions. All right, so the one that we had the 3 on was this one. So it's 3326. So if I go here and I say contains 3326. All right, so here we go. We can see that we have no variance. And the reason we don't have a variance is because we use the cost sheet. And the cost sheet, it's not a variance because we had 30, we said the purchase price was $30 and we bought it for $30. And then that $2.32 or whatever, 35 cents, whatever it was, that value actually went to those absorption accounts. So it's not actually a variance. However, if we were to look at this one where we didn't use the cost sheet, and it's 13th, so 330. Here we can see that we do have a variance for $2.35. And the reason we have that variance, and again, we can kind of click through some of these, but down here at the bottom it gives you the cost group and the cost and the variance. If we look at the vouchers, that's where again we're going to see our variance there. You don't know the why. Like I don't know why I had that variance for $2.35. And I won't because it's built into the standard cost. So because I said my standard cost was $32.35, but I paid $30 for it. I don't know where that $2.35 came from as an accountant. So if I'm the controller, I would be sitting there calling up the purchasing person saying, hey, did we get a good deal on this? Like, why do I have that? So you don't have the ability to know where that $2.35 went unless you're using the cost sheet. If you're using the cost sheet, there's no variance because it's really not a variance. It's went into those absorption accounts. Good. More questions?
Super. I think we don't have any question, but if yes, can ask.
Standard cost is a big topic. You almost have to break it off into chunks and do it. So this is a purchasing chunk. Another chunk would be around production. Because there's a lot to it at the end of the day. But again, it's one of those things, once you get it set up, it just works. And so for me, I'm very partial to standard cost because I like to know my variances. But depending on the type of product you're making, it may or may not make sense to use standard cost.
That's true. Absolutely. Yeah. I think we don't have any other question, but I'd say there have been many questions in the chat, and I also feel, costing, be it standard cost and other costing is some area which not a vast knowledge we have in the market, like in blog, very few documents or something is there, in the blog side and all. But I think this session definitely who has joined and also will see as online will definitely help them to understand what is standard cost and how this works.
I have blogged about costing quite a bit on my site. So if you do want to know more about costing, you can go check out my website, my blog site. Just when you get there, just search for cost or costing, and you'll be able to see some more blogs there about the different pieces of it. So
super. Thank you so much, Alicia, for your time.
My pleasure.
And thank you to everyone who has joined. And this was a great presentation, I'd say.
Very good. Thank you all. Have a great rest of your
much.
day. Thank you.
Thank
Bye-bye.
you. Thank you so much, everyone. Thank you so much, Alicia. We'll see you soon.
Yeah, see you soon. Thank you. Bye-bye.
Yeah. Thank you. Bye bye.